you say Silicon Valley Bank, okay, what did they do? Well, they did every banker since the Middle Ages has made the same mistake. You borrow short, lend long. So they took in deposits. I think 125 billion of deposits broken into, I think about 75 in the hold maturity and 40 or so in the available for sale category. So, over $100 billion in deposits. Like, what do you do with the money? A lot of it was loaned to their clients, these tech startups, mostly Silicon Valley, but not exclusively. There's a lot in Massachusetts, some internationally, et cetera. But it was kind of like the other way around. Like, I'll make you the loan, but when I make you the loan, I want you to put it in my bank. So the two sides of the balance sheet, the loan is to the tech startup, but then they put the money in the bank. And so the depositor is also the tech startup, not exclusively. And these are not all startups, by the way. Some of these are, Vox and Roku, and some of these are, mature, successful companies. And they had, in some cases, $2, $3, $5 billion in the bank. And so they used to play to their balance sheet. But in addition to making loans, that was only about half the portfolio. The rest of it they put into government securities, U.S. Treasury securities, and not just Treasury securities, but the long end, 30-year bonds. Not exclusively, but heavy on 30-year bonds. So you sit there and say, well, I'm paying my depositors 1% and the bonds yield 2%, and I can leverage it, 30 to 1 or whatever the regulators allow, because the bond is not considered a risky asset. And the thing about a treasury bond, it's not risky in the credit sense, but it's extremely risky in the market sense. And so when we say risk, it's a bundle risk. You've got maturity, credit, foreign exchange, settlement risk. There's all kinds of risk. So they were just looking at the default risk, which is close to zero, but the market risk is huge. And the longer the maturity, the more volatile it is. So they got all these bonds, and they're making spreads, and it's leveraged, and the returns on equity are huge, and they're partying. I mean, they're taking all this money and going on, staff ski vacations and all this stuff. I've seen it all before on Wall Street. This is not a new story. But you say, well, what happens when interest rates go up? Well, bond math 101 is, if rates go up, the value goes down. Rates go down, the value goes up. It's a little counterintuitive, but it's really simple. The value moves inversely to the rates. Well, March 2022, what happens? Jay Powell starts raising interest rates, and he kept going through 8 meetings. So get it up to 5%. So the whole time rates are going up, what's happening to the bond portfolio at Silicon Valley Bank? It's going down in value. There are huge unrealized losses in the billions of dollars. So why wasn't the bank, kind of out of business, 6 months ago or a year ago? Well, the answer is they parked most of these bonds, not all of them, but 2/3 of them, in something called hold to maturity, or HTM account. That means you don't have to mark to market. You have an exception to the mark to market rule. So if you paid $100 million for the bonds and it's only worth $80 million because interest rates went up, you carry it on your balance sheet at $100 million. You don't have to mark down to the 80. So you have a $20 billion, in my example, you have a $20 billion unrealized loss, but you don't have to do anything about it because you don't mark to market. When, hey, we'll hold them for 30 years and get paid off and mature and we get all our money back. What's the problem? Well, the problem is you're relying on the deposits staying where they are. And by the way, it's come to light that Silicon Valley Bank in the loan agreement said, when we lend you this money, you have to put it in Silicon Valley Bank, and you may not put it in any other bank. And I mean, one of the ways as a depositor, one of the ways you diversify risk is, take the money and put it in 5 banks. A little more paperwork, but if one of these banks goes down, I've still got the other 4, I'm good to go. As soon as the depositors start taking money, and by the way, these deposits started to flee when all this happened. So there was some leakage. Moody's was saying we're going to downgrade you, but that was not announced publicly. The mark-to-market losses were there, but that was not announced publicly. They brought in Goldman Sachs to try to raise capital. So they had a plan. So as the deposits are fleeing, now they have to sell the bonds to get the cash to pay the depositors. So that whole thing about don't mark to market, hold to maturity, you don't have to mark to market. Well, that's true if you're holding them. But the minute you have to sell it to pay off depositors, you take the hit then and there. There's no more deferral of that hit. So they were having to do that. So Goldman Sachs said, okay, here's the plan. Sell the bonds, sell some extra bonds, sell some additional bonds, reinvest them in higher yielding bonds. That'll satisfy Moody's. You'll still get a downgrade, but it won't be severe. And we'll raise $2.5 billion for you. So they were taking a $1.8 billion hit, and that had to be announced because they're a public company and they're regulated. But Goldman says, we'll go raise $2.5 billion. That'll fill the hole in the balance sheet, make you stable, et cetera. and they got a $500 million circle from General Atlantic. They were going. It's a very large, prominent Connecticut-based venture capital private equity fund. They were going to do $500 million, and then Goldman was working the phone, was trying to get the rest. What happened was, as soon as they announced the loss and Moody's did the downgrade, you should have been ready to close the deal right then, like the next day. It's like, okay, and by the way, here's the $2.5 billion. They didn't, and then there's a lot of there's the market risk we described, but there's just a lot of gross incompetence at Silicon Valley Bank. They had, we're talking about risk management right now, they had a vacancy in the risk management officer. There was like 6 months or more. Nobody was in the position. They weren't thinking about it. And then at least, and there were some good lawyers, and Sullivan and Cromwell, they represent Goldman Sachs. But Silicon Valley wasn't even ready to sign NDAs. Like the potential investors were like, okay, we'll take a look, sign this NDA, and give us all your books and records. And by the way, this is hairy, so it's going to take a couple days. Why wasn't all that done, a week prior or longer? And why wasn't SVB able to get their lawyers to stay up all night and do the non-disclosure agreements? So they bungled it. They lost the opportunity. And then Peter Thiel says, get all your money out, and other VCs. I'm not blaming Peter Thiel. That was actually a very smart thing to say. But then it was just over before Goldman could get the deal done. Government takes it over on Friday night. Now, here's where it gets really interesting. The government press release from the FDIC said, okay, actually it was the state of California shut them down, appointed the FDIC as receiver. FDIC sends a press release on Friday and says, okay, we're in charge. But the press release, I read it closely, it was interesting. It said, okay, all deposits of $250,000 or less, you're fully insured, you're getting your money, it'll be there on Monday. Everybody else is wiped out. That your deposit is gone, not just frozen, but gone. They gave them what they call a receivership certificate. So here's like a no liquid IOU. And you say, well, what's that worth? And the answer is, we don't know. We have to sell assets, and then we'll pay off creditors, including yourselves, and you'll get something on your receivership certificate. It's like, yeah, is it 10 cents on the dollar, 90 cents on the dollar? No one knows. I mean, you can guess, but they don't know until they sell the assets. Meanwhile, who's got the receivership certificate? Who used to be a depositor? All these startups we talked about. Well, I don't care if you have 25 employees and $2 million in working capital. You got a payroll. You got to pay the rent, pay the employees, pay the vendors, pay the developers, the coders, et cetera. And they couldn't because their money was gone. So now they were just going to sequentially and very rapidly fail. They were going to, file for bankruptcy or close their doors because they literally couldn't meet payroll. What were these startups doing? Well, everyone thinks, I must be working on a new app. That's not true. A lot of them were climate-related, sustainable resource startups. They were working on the Green New Deal. If you look at the Inflation Reduction Act that Nancy Pelosi pushed through last August, it was about $800 billion, a little bit more, maybe $900 billion. But that was called the Inflation Reduction Act, which was nonsense. That was the Green New Deal. That was the Green New Deal that AOC wanted from the start, and not all the money, but well over $200 billion was available for rebates, tax refunds, tax credits, et cetera, for people doing work in so-called sustainable resources. And now we don't have 5 hours to talk about why the Green New Deal is the Green New Scam. That's a separate topic. But there's no doubt that the White House favored it and the Democrats favored it. So not only do you have Democratic donors, but the clients of Silicon Valley Bank were working on projects that are completely favored by elites, Democrats and Republicans. And a lot of their business models were based on getting these tax credits. So all of a sudden, you were not just blowing up a bank and the tech startups, you were blowing up a lot of initiative in the climate change arena, which, again, I have a low view of that, but doesn't matter. The White House thinks it's great. So the ripple effects of this went on and on.